I want to add to the finance one that Daniel and Elaine have been talking about.
Yeah.
Of course, the big one is going to be transportation, oil, and cars.
Yeah.
And that's an elephant, right? Because we know that we can see all this coming to fruition right now. Aramco, which is the Saudi private oil company, is talking about listing its assets for between $1 and $3 trillion. You've seen the PEs of General Motors, Daimler, VW, Ford, all contract into single digits. GM's on 5, Daimler's on 8. So you can see that these companies, which are in the old kind of petrol-driven, engine, when that's about to get basically swept away entirely. Because one of the things that the electric car does, and we talk about this a lot, is it removes crankshafts, it removes oil filters, it removes gearboxes, it removes exhaust systems, it removes catalytic crackers. All those things come out of cars, and if you think of the value chain that's associated with that, then if you take the multi-trillion-dollar stuff that's happening in the oil companies and then add it to the probably sub-trillion-dollar of value in the car companies, you get some very, very major levels of disruption. The car companies in the United States are already coming down into these single-digit multiples, and we can see that happening already. So to pick up on your point about the risk of not investing in disruption, if you're just sitting there as a shareholder in Exxon or General Motors thinking, oh, that's okay, these car companies and oil companies are going to be right for the next couple of years, well, they're already starting to derate. And what we've seen is that once the derating process starts, it continues. We can see the perfect storm coming towards us with respect to oil. And self-driving cars is another layer on top of that as well, because when you get the self-driving car, then the whole idea of needing to own a car falls apart as well, because you call up a car, it arrives to where you are, you get out of the car moves along to somebody else. It's not a taxi. A taxi is way more expensive because a taxi includes the cost of a driver. Once you take the cost of the driver out, you cut the cost of the car in half. And in doing that, you make the car not just a little bit cheaper as a taxi, you make it dramatically cheaper. And that changes the whole paradigm. So to answer a couple of those questions, and then to circle back on the question about boards, the story with respect to what's going on, and I've seen it for years in this country with respect to the boards of media companies and others besides, is if you seriously ask board directors, do they know that this storm that Daniel talks about is coming, they will privately say, of course they do, and of course they do. They are not stupid people. But they are driven by incumbency, meaning that their numbers and their executive teams and their remuneration structures are all driven ultimately off the share price. And in order to keep their management team paid, so to speak, what they need to do is keep the share price high and keep investor confidence high. That is why it's not that the directors don't know, they absolutely know. They are stuck in this thing, which is we must continue to talk the story as it is. Multiples derate. You and the investor see it as an absence of growth initially and then negative growth. Meanwhile, companies that you think are on high PEs, as it were, kind of keep getting higher as the disruption takes place. I'm sorry for that long answer.